Welcome to the Opening Bell Report.
Okay, I have a number for you, and I want you to be completely honest with me. If I sat down across from you and told you there's a stock out there with a projected upside of 650%, what is your immediate gut reaction?
My gut reaction. I would assume you're about to try and sell me a crypto coin with a dog on it.
Right.
Or, some penny stock that's going to zero by next Tuesday.
Exactly. It triggers that scam alert in your brain. It just sounds too good to be true. But that is the number we are grappling with today. We are looking at a company called Dragonfly Energy Holdings, ticker symbol DFLI.
DFLI, got it.
Currently, it's trading in what I'd call the bargain bin, right around $2.30. It's testing 52-week lows. I mean, if you just look at the chart, it looks ugly.
It's a falling knife, graphically speaking,
But then you pull up the analyst reports, specifically a financial analysis from mid-February 2026. And the consensus price target isn't $3, it's not $5, it is $17.50.
That's where that 650% gap comes from.
That's the one. So the mission for this deep dive is, well, it's pretty simple. We have to figure out if this is the actual bargain of the century or if the market knows something the analysts are ignoring. Because usually when there's a gap this wide between the price and the value,
there's a dead body buried somewhere.
Yes.
That's the perfect way to frame it.
This is a story about divergence, massive divergence. On one side, you have the stock price saying this company is on life support. On the other side, you have the business fundamentals, revenue, margins, partnerships, which, represent the actual health of the company. And those metrics are screaming, we are growing faster than ever.
Okay, so let's peel this onion layer by layer. Who is Dragonfly Energy? Because when I hear energy holding company, my brain usually tunes out. It sounds like a utility provider or something.
It does sound really industrial, but they're actually a tech manufacturing company. They make batteries, specifically deep cycle lithium iron phosphate batteries. The chemistry is LiFePO4.
Okay, hold on. LiFePO4. We need to unpack that. Why does that specific chemistry matter? Why aren't they just using the same stuff that's in my laptop or, a Tesla?
That's a great question. So your laptop and most EVs, they use standard lithium ion, usually with cobalt or nickel. And those are great for energy density, packing a lot of power into a small space. But they have issues. They degrade faster, and they can be thermally unstable. You've seen the videos of battery fires, right?
Yeah, scary stuff. You can't put them out.
Right. So Dragonfly uses lithium iron phosphate. It's a little heavier, but it's the gold standard for safety and longevity. You can discharge these things to zero and recharge them thousands of times without killing the battery. And importantly, they don't catch fire.
Which explains why they got their start in the RV world.
Precisely. If you're sleeping in a van or an RV in the middle of a forest, you do not want a battery that catches fire under your bed. Dragonfly owns a brand called Battle-Born Batteries.
I actually know that brand. Yeah. If you go on any forum for van life or boondocking, Battle-Born is basically the Kleenex of batteries. It's the brand everyone wants because it just works.
They completely dominated that niche. They built a premium product that people trust implicitly to, keep the lights on and the fridge running when they're off-grid. But here's where the story pivots, and this is crucial for the whole investment thesis. If they were just an RV battery company, we wouldn't be talking about a $17 price target.
The report calls it a strategic shift. They're trying to leave the campground and get on the highway.
That's it. They're moving into industrial storage, marine applications, and the big one, heavy-duty trucking.
Semi-trucks.
Yes. And not just as an idea on a whiteboard, the report highlights a major partnership with Werner Enterprises.
Werner is massive. I see those blue trucks everywhere on the interstate. But help me understand the use case here. Why does a semi-truck need these high-tech batteries? They run on diesel.
They do, but think about what happens when a trucker parks for the night. They need to run the AC, the heater, the microwave, the TV. Traditionally, they would just idle the engine to generate power. But that burns fuel, puts wear on the engine, and makes a ton of noise.
And it's illegal in some places now, right? The anti-idling laws?
Correct. So they need an auxiliary power unit, an APU. Dragonfly's tech is replacing the old, heavy lead-acid batteries in those APUs. And the validation from Werner is a huge deal because trucking is a brutal environment. The vibration, the temperature swings. If Werner signs off on it, it tells the rest of the industry the tech is ready for prime time.
The report mentions the trucking market opportunity is 10 times larger than the RV market.
10 times. So they've conquered the small pond, and now they have a verified ticket to fish in the ocean.
Okay, so the narrative is strong. We have great tech, and we're entering a massive new market. But I'm skeptical. Narratives are cheap. Execution is expensive. The report covers the Q3 2025 filings. Is this pivot actually showing up in the bank account, or is it just a nice slide in a deck?
And this is where that divergence gets really weird. If you just looked at the stock chart down near $2, you'd assume sales are crashing. You'd think they're losing customers. But they aren't. Revenue for the quarter came in at $16 million.
That's up 26% year over year.
Exactly. In a tough economic environment, 26% growth that's nothing to sneeze at. That's real demand.
But revenue is vanity, profit is sanity.
Yeah.
What about the margins? Because usually when you pivot to a new market, your margins get crushed while you try to figure things out. You have to discount.
That is what you would expect. But look at the gross profit line. It's up 65%, and the gross margin expanded to 29.7%.
I want to pause on that. They expanded margins by over 700 basis points.
It's almost unheard of in manufacturing during a pivot. Usually you see compression. Here, we see expansion.
The report mentions a pricing war in the lithium sector. Everyone else is slashing prices. How is Dragonfly raising margins?
It comes back to that brand power we just talked about. Battleborn, they aren't selling a commodity. They are selling a premium solution. They have pricing power. They don't have to race to the bottom because their customers, whether it's an RVer or a fleet manager, are willing to pay for reliability.
So let me play devil's advocate here, because if I stop reading the report right now, I'd go buy the stock. We have a company growing revenue by 26%. Margins are booming. They just won a sustainability award. They have a deal with Werner. And yet, the stock is at $2.29. Why? The market isn't stupid. What's the catch?
The cash is cash, or rather the lack of it.
Ah, I see the critical risk factor section here in red.
It's the elephant in the room. Cash and equivalents on the balance sheet are sitting at around $2.8 million.
$2.8 million for a manufacturing company. That sounds incredibly thin. That's barely enough to cover payroll.
It is razor thin. It is uncomfortably low.
And what's their burn rate? How much are they spending just to keep the lights on?
They're burning about $2 million in EBITDA per quarter.
Okay, do the math for me. $2.8 million in the bank, $2 million out the door every quarter. That is, what, 3 months of runway?
Basically. And that explains the fear. That explains why the stock is beaten down. The market is looking at that cash balance and screaming, insolvency risk?
And even though the gross margins are great, the net income is still negative, right?
Right. Net loss of $11.1 million. That's due to interest payments on debt and some one-off costs. So they aren't profitable on the bottom line yet. They need cash to bridge the gap.
So how do they get that cash? If they have 3 months of runway, they need money yesterday.
Well, that brings us to the dreaded D word.
Dilution.
Dilution. The report notes they have a $50 million ATM facility active.
ATM at the market. It sounds convenient, like getting $20 for lunch. But for a shareholder, this is painful. Can you explain how this works?
Sure. Imagine you own a slice of a pizza. The pizza has 8 slices, you own 1. An ATM facility allows the company to suddenly cut that pizza into 16 slices to sell the new ones to strangers. Your slice just got half as big, you own the same slice, but it represents less of the total pie.
My percentage of ownership drops.
Exactly. The company prints new shares and sells them into the open market to raise cash. And because the market knows Dragonfly is desperate for cash, traders are front-running it. They're selling the stock because they expect a flood of new shares to hit, which depresses the price.
So the stock price isn't dropping because the business is bad.
Yeah.
The business is actually doing great.
Yes.
Stock is dropping because everyone is afraid of the fundraising mechanics.
You hit the nail on the head. The market is pricing in either a bankruptcy or a massive chaotic dilution event where the share count just balloons.
But the analysts, they see this same data. They see the $2.8 million cash. They aren't blind. Why are they still saying $17.50? Why aren't they saying sell and run away?
Because they believe the bankruptcy risk is overstated. They believe the company will secure the funding, and once that cloud lifts, the valuation will snap back to reality, and the math behind that snapback is, it's wild.
Let's talk about that math, the valuation gap.
Yeah.
How do you justify a 600% jump? It sounds like magic.
It isn't magic, it's comparative math. You use peer re-rating, you look at what other similar companies are trading at. Right now, Dragonfly trades at 0.6 times its sales.
0.6, yeah. That is dirt cheap. That's usually for companies that are shrinking or dying, not growing 26%.
Exactly. It's distressed asset pricing. Now let's look at a peer. Take Fluence Energy. They do energy storage, massive scale. They trade at about 1.3 times sales.
Okay, so double what Dragonfly is at.
Right. If Dragonfly just traded at that same multiple 1.3, the stock would double instantly to $4.60.
That's to be average.
Just to be average. But then look at EOS Energy. They're another battery tech company, specifically zinc-based. They trade at 4 times sales.
4 times.
If Dragonfly were valued like EOS, the stock would be at $14.
Wow. So the 1750 target isn't pulling a number out of thin air. It's basically saying if Dragonfly succeeds in the trucking market, it should be valued like a high-growth tech company, not a failing manufacturer.
Correct. The analysts are arguing that it's mathematically absurd for a company with this growth profile and these margins to trade at 0.6 times sales. It's a total mismatch.
The report also mentioned something interesting about the efficiency defense. It compares Dragonfly to EOS Energy directly.
Yes, and this gives me some comfort regarding the management team. EOS burns a massive amount of cash relative to their revenue to achieve their growth. They were spending heavily to acquire customers. Dragonfly is surprisingly disciplined. They're burning $2 million on $16 million in revenue.
They're running a tighter ship.
Much tighter. It suggests that they aren't a bottomless pit. They're a functional business that just needs a bridge loan or a capital injection to get to the other side.
There is another factor here that could cause an explosive move, separate from the fundamentals, the technical setup.
Oh, yes.
The squeeze potential. Short interest is at 12.7%.
Which is high. That means more than 1 in 10 shares has been sold short.
And the float, the number of shares available to trade, is tiny. Only 12 million shares.
That is a classic powder keg. You have a low supply of shares. You have a lot of people betting against the stock. If Dragonfly announces good news, say a new funding deal or a massive purchase order from Werner, those short sellers have to cover. They have to buy the stock back to close their position.
But there aren't many shares to buy.
Which drives the price up, which forces more shorts to cover. It's a feedback loop, a short squeeze.
So we have a deep value stock, a growth stock, and a squeeze candidate all rolled into one. But we also have this looming shadow of the cash crunch. The report calls this the binary zone.
It really is binary. There's no middle ground here.
Break down the two paths for me.
Path 1. The bear case wins. They can't raise money efficiently. The dilution spirals out of control, or worse, they run out of cash entirely. In that scenario, the stock drifts lower, maybe even below $1. It becomes a penny stock graveyard.
And path 2?
Path 2, the bull case. They fix the balance sheet, maybe a strategic investment from a partner, maybe a debt restructuring. As soon as they announce we have cash for the next 2 years, the bankruptcy risk vanishes. The market suddenly focuses on the 26% growth and the 30% margins. The stock re-rates, potentially toward that 1750 target.
It is a fork in the road.
It is. And the report makes a fascinating analogy. It says investors shouldn't view this as buying a stock. They should view it as a venture capital style trade on the public market.
I love that line. But let's explain what that means for the average listener who maybe doesn't hang out on Sand Hill Road.
Well, think about venture capital. VC firms invest in companies that are risky, companies that might run out of cash. But they invest because if the company does make it, the returns are massive. 10 times, 20 times your money. Usually, regular people can't make those bets. You have to be an accredited investor to get into a startup.
But Dragonfly's public.
Right. You can buy a share for $2.30. You're taking on VC-level risk, the risk that it might not work out, but you're getting access to VC-level potential returns. 600% upside.
It reframes the whole decision. You aren't buying Coca-Cola here. You aren't buying a safe dividend. You're buying a ticket on a turnaround story.
A turnaround story with a very specific catalyst. We're just waiting to see how they solve the money problem.
So if I'm summarizing this for someone listening who is thinking, is this for me?
If you can't stomach volatility, if you lose sleep over a stock dropping 10% in a day, stay away. This is not for you. This is going to be a bumpy ride.
But if you're looking for high risk, high reward asymmetry,
then the data is compelling. The business is working. The product is working. The only thing broken is the balance sheet. And balance sheets can be fixed.
the report notes that support seems to be forming at $2. So if it holds there, that gap down we saw recently might have been the selling exhaustion, the last gasp of the bears.
It certainly looks like capitulation. The volume has been high on the sell-off, which often signals that the weak hands are washing out.
I want to leave the listeners with this thought, and it's something that stuck with me while reading through the risks section. Right now, the market is obsessed with how Dragonfly raises cash. Everyone is staring at that ATM facility, terrified of the dilution. It's all anyone on the message boards talks about.
Fear tends to narrow your focus. You just stare at the immediate threat.
Exactly. But nobody seems to be asking why they need the cash. They aren't raising cash to pay off a lawsuit. They aren't raising cash to fix a defective product.
No, they need cash to build inventory.
They need cash to fuel a 26% growth engine in a market that is 10 times larger than where they started. That's a good problem to have, historically speaking.
It is. It's growing pains, not death throes.
So the question is, if that funding overhang clears, if they get the cash and the market stops panicking about the how, does Wall Street suddenly wake up and realize they accidentally put a premium growth company in the bargain bin?
That is the $28 million question. And if the answer is yes, that gap to 1750 closes very, very quickly.
It's a fascinating setup. Dangerous, but fascinating. As always, we have to say it. None of this is financial advice. We're just two people reading reports, so you don't have to. Do your own due diligence.
Always. Read the filings, check the numbers.
Thanks for taking this deep dive with us. We will be watching DFLI closely to see which path they take. See you in the next one.
Catch you later.
Don't forget to like, share, and subscribe for more.